Compliment of the season to everyone, and I can say good morning, good afternoon, and good evening, wherever we are connecting from. And I must say, thank you all for joining this our session today. I know this is our festive period, and I know it's either a busy period or holiday period for everyone. So thank you so much for joining this our live session. My name is Victor Ogundele, and I will be our host for today, right? And I want you to know that this is a knowledge sharing session, which means we are discussing. So it's not like a teacher to students kind of session. I will be more focused on the practical part of this, right? I'm quite sure if you attended any of my webinar, you definitely know that we like to make it practical. I feel that's the best way to learn anything we want to learn. So once again, thank you all. We also understand that some people might not be able to join because of different time zone. But what we are going to do is we are going to put, we've already started recording, and we'll also share this at the end of the webinar. So once again, I say a very big welcome to every one of us. So let's get started. Let me pause my video. Maybe I can switch that on later. Right. So I believe we all can hear me clearly. So please, if you can hear me clearly, please type yes in the chat box. So I'm sure we are all on the same page. And just go to the chat box and type yes, 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 so that I'm sure we are together. Okay, all right. Thank you for that. So as I said, this is just a knowledge sharing session. If you have any question, you can type in the chat box. If you want to maybe add, you want to comment, you want to add to any of the discussion we are having, you want to remove from it, you can also share your own knowledge, right? As I said, this is just a knowledge sharing session. It's not a teacher to students. I'm also a learner. Right. Okay. So once again, welcome to Time Out with Victor on Financial Modeling free webinar session. And today we want to discuss what we call networking capital. And this guy is just very, very important. As I don't know how you want to put it. Understanding how management think about cash and manage cash in the business operations. Now, let me tell you a little bit about myself. As I said, my name is Victor Ogundele. Microsoft MVP, and I'm a senior business valuation and financial modeling analyst, and I work with Deloitte Nigeria. And also, I'm a certified financial modeler, project finance modeling analyst, valuation analyst. I also have certification when it comes to business presentation and analytical skill. All right, so I'm a Microsoft most valuable professional. I think this should be the third year, 2021, 22, and 2023. So I'm a financial modeling trainer of the year for the year 2022, as recognized by Financial Modeling Global Summit Award. Yes, I was recognized as the Financial Modeling Trainer of the year, and we hope we continue the good work. So I was also recognized as one of the top 6 top financial modeler in African region by Financial Modeling World Cup. And in year 2021, I was also selected as one of the top Microsoft Excel users in 2021. This is a competition organized by Financial Modeling World Cup. I'm a convener of the Timeouts with Victor on free financial modeling bootcamp program. And also, I'm an assistant team lead of digital team in Deloitte West Africa. I was recognized as the top performance staff of the year for valuation and modeling units in Deloitte's African region for year 2023. And I've also been able to work on more than 200 portfolio projects, including project finance, infrastructure, modeling, startup, corporates, just name it, and I've also trained over 5,000 personnel as well. So don't let me bore you much about myself. I just said you should get to know the guy that will be talking to you today. So what are the things we'll be discussing today? Understanding the concept of networking capital. This is very, very important. And I'm sure by the end of this training, I know you might need to go back if you operate in a management role. I'm sure you might need to go back and look at one or two things, all right, based on what we'll be discussing today. So building a monthly networking capital schedule. I know this is one of the challenges that we modelers usually face because we are so well, our formula for our net working capital that we know seems to just consider it on a yearly basis. Then when you are building your model, how do you build this monthly? A monthly basis, which is more like the operational kind of modeling approach. Okay, so we understand the changes in net working capital. Then how do we incorporate seasonality in building our net working capital? Then we also discuss how you make provision for irrecoverable receivables. Those are things that can affect cash, right? Can also affect the sustainability of business at the long run. Then understanding the impact of net working capital on cash flow and business valuation. In fact, when it comes to business valuation, we don't joke with net working capital. Yes, because it's it can drop a company value by 50%. I'm talking from practical experience. Yes. So which means it must be modeled correctly, right? So let's get started. Net working capital, what does it entail? Most times when I'm teaching people about financial modeling, I usually tell them that, you know what, we have two approaches when it comes to dealing with financial model. We have the technical part of it and we have the mechanical aspect of it. Now, most people tend to focus on the technical, go to Excel, start punching values and putting it there and just leave it. But no, it's way beyond that. Even you as owner of business, you are in a management role. You need to be able to understand this. It is strategy that is being transformed into figures. So if the stories are not aligning, then trust me, it's off. So as a modeler, you need to understand the mechanical aspect of it, how business run, how management think about business. Now, let's take a look at this. What does it entail? It's all about cash. That's one thing I want you to know. Whenever you hear net working capital, just know that it is what net working capital is saying is how have we manage our cash? And I'm sure you know that cash is king. Once you exhaust your cash, they'll just be going on. The reason why a business will say we want to secure funding is because they need more cash. So it's all about cash. And that's the whole concept of net working capital, which we are going to discuss further. Now, it is crucial to sustainability of every business. Israel, we can see your face. We can see your face. You look good. Mind switching off your video. So it is crucial to sustainability of every business. Right? Because that's the whole thing about business. Net working capital. And I'm going to show you something about balance sheets for us to even understand it better. You also need to understand that management has a different approach to how they see net working capital. Because it is the business itself. Trust me, if you are selling, because and that's the whole concept where we are saying, yes, a business can be profitable and not viable. Right? A business can be profitable and not viable. A business can be profitable and cash deficit. Now, in other words, which means a business can be making losses and have a good cash stand. So many things can cause that. We're not going into that today. Now, we also have what we call industry-based net working capital cycle. There are some specific industry. Their own is, hey, they pay suppliers before they can even get their raw material. There are other industries which they can tell supplier, you know what, based on our company policy, we will pay you in so number of this. There are even another industry, whereas supplier will the customers, they would have paid up front. And we are going to see those scenarios in this webinar as well. As I said, it's all about cash management, gratification delay. The reason why they are paying most of those top management personnel is because of their understanding of concepts like this. And you as a modeler, analyst, you also need to understand how it flows. And when we say our network, what is our net working capital? Majorly, we are saying our current assets minus our what? Our current liabilities. Our current assets minus our current liability. Blessing, you look good. I think this is the mode of festive period. You can see your video. I trust you are good. Yeah. Okay. So net working capital, as I said, current assets minus current liability. And based on our basic understanding of it, current assets, we have our inventories, we have our trade receivables. Right? We have our inventories, we have our receivables under our current assets. Then for our current liabilities, we have our trade payables. Now, some people will be wondering, so when we are saying net working capital and we are saying current assets, we are just picking only two. Current liability, we can have different line items, and we are just picking only one. Now, as I said, one thing I want you to understand is this: net working capital is all about cash. How have we managed our cash? Now, let's take a look at it. I want to get a result of something. Now, the result of what I want to get, I'm now adding it to the calculation. Definitely it's going to give something like a circularity or iteration, right? So, which means we need to exclude some line item in our current assets and in our current liabilities. And those are line items that are more like cash itself. And I know at times we usually ask that what's the difference between working capital and net working capital? It's just those exceptions. So for current asset, any line item that are cash elements, we tend to remove it. Right? As I said, because we want to get how we manage our cash, then it does not make sense for us to now be adding that same cash again. So also in our current liability, we look at line items that are interest bearing, which means we've gotten funding from somewhere. We remove that. For example, our overdraft, short-term borrowings, those line items, we tend to remove it. Now, there are times where we have to take a step further and we consider some other line item, and I've included them as exception. For example, prepayment. Now, due to our standard and our accounting standard saying, okay, you know what, this, there are some line item that can also affect the cash management. So I said, yes, it's optional. There are cases where we include it. There are some cases where you don't include it. In liability, there are some cases where we include our accruals and also our deferred revenue based on what we want to achieve. Now, as I said, I love things to be very, very practical. Let's take a look at a typical cash conversion cycle of a business. As I said, we understand that, oh, you know what, current assets, current liability, that's the net working capital. Now, how does it make sense? How do you understand this better? Let's take a look at a company that is producing chocolate bars, right? I think I love chocolate a lot. In case you don't take chocolate, just think about anything, right? Right. So we have Snickers, we have just those different chocolates, or think about milk or just any product. Any manufacturing product is always good when you want to explain a concept. Now, for a company that is producing chocolate bars, you will agree with me that the first thing that they will need to get is to get raw material, which is the same thing as the what? As the inventory. So they need to get the what? They need to get their raw material. Now, in getting the raw material, this is the question I would like to ask. Do we think this will include cash or this will not include cash? That's the first question you should ask yourself. Company that want to be producing chocolate bars, they said the first thing is they need to get raw material, same thing as inventory. And the next question is, in buying this product, do you think are they getting it in cash? Do you think cash is involved or cash is not involved? Let's think about that. So I would like you to type in the chat box. If you have the opinion that yes, cash is involved, type yes. If you feel cash might not be involved, just type no. And I think from our response, I also know the consultant in the house. Okay, do you think cash is involved, or do you think cash is not involved in them getting their raw material? So I would like us to, let's make use of this chat box so that we can always type. Okay, yes, someone is saying cash is involved. Now Victor comes with the consultant response. Which one is yes or no? Okay, so let's the truth is it depends. Let's just borrow that statement from our consultants. Maybe I think our consultants are now coming up. Maybe or maybe not. It depends. I agree with you. The truth is it depends. But let's take a look at a scenario where this company is managing their cash effectively. You know what they will do? They will go and meet the supplier. And they will tell the supplier that, hey, supplier, you know what? Please give us this product on credit. Give us this product on credit. Based on our company policy, we usually pay in so number of days. And the supplier will be like, okay, this raw material, if I have it in my store, it's not as if I can eat it. If the company is saying, okay, yes, they can, this they are based on their company policy, they will pay in so number of days. You know what? Let's assume cash is not involved. So the supplier has decided to give us this product on credit. So which means now we've collected the product on credit, bring it to our own factory. It took us 15 days to process and have the final product. Right? It took us 15 days to process and have the final product ready on our shelf. And once the product is ready on the shelf, what do you think the next thing will be? Then we deliver it to our distributor. Let's assume we are not selling directly to the last end customer. We deliver it to our distributor. Now, it takes 5 days to take the final product from the shelf to the distributor. So which means 50 days to process, have the finished product ready, we put it on our own store, right? Okay, someone is saying they cannot hear me. Maybe you might want to log out and log in again. So it took 5 days, right? After we've processed the product, put it on our shelves. It took 5 days for us to take it out, which means like 5 days before the distributor requests that, oh, you know what, let's make this order and please give us your product. Let's assume they are selling directly to the supermarkets. Now, from the 15 days, which it took us in processing it, getting it ready on our shelf and taking it out, we call it inventory days. So which means it took this business 15 days to process, 5 days to put it on the shelf before it gets out of this company store, right? So it took 20 days. So whenever you see anything like inventory days, it's basically telling you that what? It took this business, this total number of days to process. So you might not see the information for a typical corporate firm. You might not see the information on the product, but it's basically telling you from then getting the raw material, processing and getting it out of their store, it took this number of days. Now let me now ask you again. You've delivered to the distributor. Then the next thing is what? They need to pay us. Now let me now ask us. On the part of our distributor, do we think cash would be involved or cash will not be involved? That's another one. And the reason why I'm asking is this. You need to know that your own input is someone else's output. Someone else's output is your own input. Now, the distributor, let's assume the distributor is also maintaining a good cash management. You know what the distributor will tell us? The distributor will also tell us that, hey, based on our own company policy, you know what? Give us this, your product. And we will also pay you so number of this. Now, you can see that the story is now becoming funnily long, right? Because they're also trying to manage their own cash. For example, most of these supermarkets, most of those products you see on their shelf, right? In fact, at times they always have these terms and agreements where they tell them that, you know what, it's when we sell your product that we will even pay you. Right? There are some that will tell you, okay, you know what, we'll pay you so number of this. We believe we should be able to sell your product within those periods. So which means this business will still now wait. There's no cash. Let's assume no cash is involved yet. Now, the best thing is to now try and make sure that we chase this distributor to now pay us. Now, let's now assume from delivering the product to the distributor and collecting cash, let's assume the distributor told us that, hey, after 30 days, a month, that will pay you your money. The first money came into this cycle, right? Which is what we now call receivable days. So which means, if you take a look at this closely, it took 50 days before the first cash came into this business. Using this particular scenario, it took 50 days because inventory, 20 days, receivables, you need to chase your distributor. The first cash came in 50 days. Then the next thing is what? We now need to do what? Pay these suppliers. Now, the supplier has been waiting. So which means for the first 50 days, nothing for the suppliers. The next thing is we now need to pay the suppliers. Now, look at this. Assume we have a payable days of 60 days. That's more like after 2 months. That's when we are paying this. Yes, at times here, you know that the supplier too might have added their own additional discounts because you are delaying. But there are some scenario where we do more like a net present value, NPV, and say, okay, you know what? There's some where management just tends to make that decision. Tell them, you know what? If you pay us today, we give you this discount. Because by the time they look at the present value of they collect the cash today, and whenever you will pay, you say, okay, you know what, we'll give you a discount, pay us today, or if you are paying us in this also number of that means we might need to add this to it. Then the cash outflow. Now, if you notice something, it took us 50 days to collect cash, to bring in the first cash. And we paid our suppliers in 60 days, which means we have 10 days free, a gap. And the concept is now saying, you know what, the longer the gap between you receiving your money and you paying your supplier, the better. Because it's more like a free money. Let's assume everything being equal. So you have a free cash at hand for 10 days. You could decide to even invest it in any short-term investments and get something from it. So the longer the gap between receivables and paying suppliers, the better. Now, I know you might be thinking, someone might be thinking, does this really make sense? And that will now take us to the next thing where I want us to also understand it better. Because there are always two sides to every story. Right? As I said, you can look at the gap. We said the longer the gap between receivables and paying supplier, the better. That's for the management. Now, supplier has been waiting all this while. It's not a good cash management on their own part. And that's where the two sides of the story thing comes into play. Right? And I want you to know that every financial story has at least two sides. Now, the question is, do you know how to interpret all sides of the story? And on this material, I will give credit to Dubran Consulting. I think he had kind of created this interesting visualization for us to explain this concept. Now, balance sheet is, in fact, I feel it's one of the most important financial statements to any business, because the first value of a business can be seen in their assets. The earning story, everything ends, cash flow, profit or loss account, everything ends here. Now, we have two sides when it comes to balance sheet. And here we have our 5-box concepts. We have balance sheets can only contain two things. And is what? Funding and use of fund. Use of fund or source of funding to the business. So there's a way we analysts, we take a look at the financial statements. And that's why most time when accountants are creating their financials, they are cooking, they are making different things. We sit back, just send it to us, and we will tell you that this is not just making sense. Now, as I said, balance sheets can only contain two things: sources of funding and use of funds. That's any line item you see in the balance sheet. And under all our sources of funding, we can see our shareholders fund, equity, long-term loan, which we know as our non-current liabilities. Then we have our current liabilities. On the part of the use of fund, we have our fixed assets and current assets. So, source of funding, use of fund. Now, we now have two sides to it. We have a side which we call the long source of funding. And based on our accounting concepts, right, is saying long-term source of funding, which is our equity and non-current liabilities, should be able to fund the long section of our use of fund under the asset. In other words, it's saying equity plus non-current liabilities should always equal to our fixed assets. But the truth is, I'm not sure I've seen any business that operates on that basis. But it's always good for us to understand the basic concept first. So he's saying long source of funding should be funding the long use of funding. But now you can see this now that definitely this is not balanced. The second part is now saying short source of funding should also be funding short use of funds. Now, most people don't believe current liability is a source of funding. Just from that cash cycle that we just explained, right? You can see that the suppliers was the one funding the business, because what if the suppliers rejected to give us that our product on credit? That means we need to go and source for funding somewhere. So the fact that, hey, okay, you know what, give us this. And that's why salaries are also what they are being paid on accrued. We accrued so they pay you at the end. It's all about the concept of that cash management. As at that time, we are funding the business, because typically I go to work today. At the end of the day, you're supposed to pay me. I say, okay, yo, thanks for coming. Don't worry, I'll settle you at the end of the month. Second day, oh, don't worry, I'll settle you at the end of the month. So it means they are using that money to fund the business operation till then. Now you can see this current liability seems not to be funding current assets, right? And the next question is what? You can see that there is a gap, right? Because the short source of funding is not funding the other one. Now, at times, yes, there might be a scenario where you see that long source of funding is even funding current. The next question is it good? Is it not good? It depends. Current liability at times, current source of funding at times can even be funding current use of fund and also fund part of the non-current use of funds. So what we do is you just look for a company financials, you put it together, you create this visual. And one thing we do is we play it over time to see how the business been managing themselves and be able to tell a different story from here. So now we can see that there's a gap between current liability and current assets. Now the next question is, what is the name of this gap? And that is what we call working capital. That's what we call working capital. Now, this is where the two sides of the story comes into play. For management always prefers to have current liability higher than current assets at every time. Because of what? It's just like a source of funding with at least cost of funding. The supplier that has supplied the products, right? The max is they might have added just few addition to it, but it cannot be compared to the interest you will get if you go and borrow the money from the bank. Cannot be compared to what the equity holder will be asking and different costs attached to it. Right? The salary that I was supposed to pay that is currently on our accrual is also funding the business. So management prefer to have current liability higher because it is as good as they are using free funding to the business. Right? So management prefer to see current liability where the customers, they've even paid you ahead. It comes here as deferred revenue, which means you have free funding that you can use to do what you want to do. The supplier that's supposed to pay, you are here to pay them. You have that excess cash, just as good as free money. But from the perspective of outsider, suppliers, people that want to invest in the business, they always prefer current assets to be greater than current liabilities. And you know why? It's for their own personal protection. So that whenever the business wants to fold up, right? Remember, nothing will happen to the shareholders' part. They want to be sure that yes, everything in current liability is even enough to settle the current. Everything in current asset is enough to settle the current liabilities. That's how our formula usually say ratio 1, right, and greater than 1. But they didn't tell us the part where management wants the free cash. So they tell a lot story about how business manage their cash. Right? There are some companies, look at their past 5 years historical, right? And you see that their current liability is always higher. That means they have a well-structured cash management. Now, this also comes with branding and different other things. Because you will go to a supplier and they'll be like, we don't even know your company. We are even exposed to different risk. To give you this product and you tend not to pay us in the next 30 days. We also need the cash to be able to use and do something. So different concepts. But as a modeler, you need to understand that different story. So management want to see this, that current liability should always be greater than current assets because it's the free funding they are using to do what? Run the operation of the business. So current assets, current liability, both of them, remember they are operational line item. Operational line item, day-to-day business operation. So they want to have free cash to be able to run their day-to-day operation. But outsider, suppliers, investors want to be sure that yes, you have enough current assets to meet all your current liability in case of anything happen. So let's go back to our first scenario. As I said, buy raw material, no cash, deliver, no cash, we collect the first cash in 30 days. We are paying suppliers, and we said the bigger the gap between when you collect your own cash and you pay, based on our concepts, right? Collect your cash quickly and delay the settlement, right? Because you have that free cash to use in the business to do one or two things. Now let's look at second scenario. As I said, industry also maintain different type of scenario. Now there's some industry whereas you need to pay the supplier first. And where you pay the suppliers, when you need to pay the supplier first, right? We call it, at times you see, call it payable days, but now it's not payable days because you need to pay them ahead. So we have deposits for import, could also form part of our prepayment, and which means you need fund. Funding is needed here. And this funding will also come with its own cost. Right? When you pay the supplier, then the supplier now deliver the product. It took you your normal 20 days before you get it out of your stock and you collect your cash. Right? Which means cash, the first cash from the operation will be coming in 50 days, which means you need funding to be able to pay that supplier. And after you now collect your own cash, you now need to do what? To settle your initial funding. You now need to settle the person that has funded this business initially. Right? Let's look at another scenario again. Now, this scenario, we buy our raw material, we've delivered it to the product, to our distributor, 20 days, right? And the next thing is, our suppliers, they only give us 30 days. In this scenario, that, hey, you need to pay me in 30 days. What do you think the next thing? That means we need the funding. We need to be able to get funding from somewhere to be able to pay these suppliers before we now collect our own cash. So which means funding is needed before you even collect your own cash in 50 days. So different cycle. At times, this can also be industry-based. Right? And this, I feel this is one of the concepts that most startups fail to understand. And that's why well-established business will tell you that, you know what, everything being equal, we even have cash that can run the business for the next 1 year, even if we don't make any revenue. Right? Yes, even though the startup also make provision for burn rate, but most of them don't apply it as needed. Right? Because the business is someone that is funding the business. If customer don't buy, if anything happen, even if you are selling, if you don't manage the cash effectively, then there will be problem. Right? It's festive period, and you know what? You just decide to, oh, we've done so great in this year, and you decide to be blowing the whole thing without even looking at what will be the outlook of what's coming in next year. What if? What if? How do I need to manage my cash? Now let's look at the fourth one. Whereas they receive advance payments from distributor. This is one of the best you want to have, right? Receivable days, so that becomes our deferred revenue, because you now have what? Upfront funding. So this just make the business easy. But the truth is, mostly the scenario 2, right? Whereas you need to pay your supplier before you even collect your own cash. It's common, right? So upfront, distributor just they pay you in advance, right? And I think this just occur rare occasion. Number one, maybe the product is high demand and the distributor feel like, you know what, I need to pay earlier so that I will be able to get the product. Or maybe they anticipate that there might be increments in pricing or something like that. So you pay your suppliers, you have funding because the funding is available already. You deliver the raw materials, you do your normal processing day, and at the end, you deliver it. Let's look at the scenario 5. Scenario 5, you collect your cash, right? You buy your raw material, then you pay the supplier at the end. I think this one is a very sweet one. You've got your upfront funding, you can use the fund to do what you want to do, right? And at the end, you are still paying this guy at the end of 50 days, which is a very good concept. So you can, as I said, whenever you learn a concept, take a look at you can take any corporate firm, you can take any model, any financials, try to create the story, try to look at it and be able to tell that story. They said it's not just about you going to this Excel, punching the value. You must be able to tell that story. So as I said, this is very practical. And now let's get straight into our Excel. Before we go into the Excel, do we have any question? Do you have any question before we go to the practical aspect of it? How do you build a monthly networking capital? If you have any question, you can just click on your hand too, or if you have any addition or you want to share any of your experience based on this cycle. Okay, yes, Mustafa.
Yeah, first and foremost, thank you so much, Mr.
Right.
Victor. Thank you so much. You have always been doing a wonderful job regarding this financial modeling free webinar. So my question just goes very straight: is that how can we able to relate the story by just picking up the financial modeling that have been done by someone? How can you be able to figure out that this is how the story that connected their networking capital modeling?
Okay, perfect. That's a very good one. So based on our accounting formula and our accounting formula, right? Whenever you pick any company in historical financials, I'm definitely sure you know you can calculate you want to calculate your inventory days, right? They will tell you that that is inventory days divided by days in a year, multiplied by your cost of sales. So the concept, the formula is still applicable. So when you pick a company financials, just go to their balance sheet, look at their inventory value, right? Do the calculation to get the days, right? Do the same thing for your payables. So just to pick those line items and do using our normal accounting formula in which we used in getting our inventory days, payable days, receivable days, and just use that to tell the story.
Perfect.
Yeah.
Thank you.
All right. Okay, Teslim, please go ahead.
Okay, thank you very much. So my question is basically because why you are so you made mention and it involves check payables.
Teslim, I'm struggling to hear you clearly. I don't know, maybe you can adjust your mic, or better still, you can type in the chat box as well.
Okay, so let me just try. Or is it better now?
Okay, I think it's better. Okay.
Okay. So you just basically how to differentiate it. So for our current assets, let's see our any trade receivables. We have trade and other receivables. Understand? So I just want to understand like the concept of we not making use of other receivables.
Teslim, I feel you might want to type it in the chat box. The background noise is overshadowing your voice. Yeah.
Okay. I'm typing in.
Okay, all right. Okay, that will be fine. Yeah. Thanks, man. Okay, yes.
Good afternoon.
Yeah, good
Good
afternoon.
afternoon. Good morning.
Good.
So I have a question. Mr. Victor, thank you very much. You've been able to, open my concept, my idea to the fact that cash conversion circle is, is very dynamic. It's not like one for fit all. And
Exactly.
depend like my company. Can you hear me?
I can hear you clearly.
Yeah, like my company now, it's diverse. They
Mhm.
use 80, they'll tell you, oh, the client must have paid us 80% before we deliver. You understand? So
Mhm.
at times they'll say, okay, they'll do some credits, they'll use LPO, you understand? In this kind of scenarios, how would you pinpoint the days receivable, you understand? Because they say the client must pay 80% before we deliver. They will also say, okay, we use an LPO, we use an APG, all of these scenarios, they mix all
Mhm.
of these in managing their receivables. Do you understand?
Mhm. Exactly. Exactly. Okay, I love
Yeah.
that. I love that.
And
So, okay, please go ahead.
and coming to the payables also, the payables depends. Some of the supplier request that they pay in full on the spot. So most of the time that they request for at least 80%, so they will to fund the supplier parts of the item. At times the supplier will say 50%, at times they can delay some of the supply, you understand. So looking at
Mhm.
that mix, as it's not like a straight jacket, like okay, you understand, like you have explained, but these guys are using one more than one strategy in that receivables and part of it. They can tell you 80%. And some clients are so benevolent enough, they can pay upfront completely, you understand. So they can use
Mhm.
the APG, some they can use the LP, say pay us in the next 30 days. You understand? So how do
Mhm.
you look at this scenario?
I love that, right? So, which means the truth is, you really cannot map out each transaction with each client individually, like we've done it, right? But the other thing is understand the concept. By the time we go to the practical, where we are putting it in Excel, I'm going to cover how you can approach what you just asked now.
Okay,
Yeah,
no problem.
yeah,
Thanks.
yeah. That's a very good point. Yeah, definitely. What we are seeing here now, definitely, is not like see it's a single individual transaction. It can be difficult to map it out like this, right? But yeah, maybe for
Yeah.
a business that's been able to have a track record of how they've been managing things, it's easy to, okay, you know what, on average basis, this is what we have, right? But for one that does not even have anything in the past, there's still a way we can do that. So by the time we get to the practical aspect of it, I'm sure we'll be able to address that.
Okay.
Thank you for that.
Thanks.
Yes. Yeah. All right. Ibrahim, your hand is up.
Yes, can you hear me, sir?
Yeah, can I? Can I?
Oh, thank you very much, Mr. Sampson. It's actually a wonderful section. I could remember when Mr. Owolabi Sampson came to our school, Obafemi Awolowo University. He was mentioning your name that you're actually doing wonderful well in the industry. So thank you for dishing out this valuable webinar. I'm actually a Part 4 student who is just focusing on finance, and I've been working on financial modeling, trying to build up some models using Excel. But then using real case scenario like this, I've never been able to at least work on company financials and all. So I want to ask, are there ways I can get company financial whereby I can practice all this scenario and all also? That's my question, sir.
Yeah, definitely, definitely. So, any companies, right, that you want, just go to try to get their websites, and you always see a section called Investors Relation, right? And you should be able to extract their historical there. In fact, aside that, you can even just go to Google Street, type download so company financials dot PDF, and I'm sure you'll be able to get it. So you can also go to NGX. You have different sources where you can download
Okay,
companies
thank you very much.
financials.
Thank you.
Yeah,
Thank you.
yeah. Well done, well done, well done. I think I really love that. Okay, all right. So any contribution from any of our online? Okay, so someone typed the chat bar. Okay, I just want to understand the concept of not making use of the other receivables and other payables when calculating the working capital. So as I said, Teslim, that you always have exception where you can include it, right? And that's also form one of the reasons why we also do financial statement restructuring, to give us your balance, you give us your financials, and we're trying to restructure it to say, hey, what are these things you've called other receivables? What are these things you've called other payables? At times you go there and you check that. For example, other payables, other receivables could be staff loans. So different line items that are really not operational in nature. So if it is not operational in nature, right, such that it can affect the business normal running, then we might not consider it. And that's one of the difference between working capital and where we are saying net working capital. Yeah, but for working capital, definitely we include everything. But for net working capital, right, said it's all about that operation and cash operational management. Yes. Okay, all right. Victor, you have your hand up.
All right, thank you so much. Yeah, actually, today is my first time of joining this webinar. I just came across it on Saturday. Fine, thank you for the job well done. My question just is related to the question to the last speaker. Now,
okay,
in Nigeria, if you want to extract financial statement, it is easy for you to just go on NGX and extract company financial statements. So I want to ask, if you are talking of other country, do you have idea of any sites that one can actually go aside going to the company website to extract their own statement as well?
Yes, yes, definitely. So the way we have NGX, right, for Nigeria, every country also they have their own, so you can always check.
Thank you.
Right. Yes. Okay. So because of our time, let's try to manage our time. I know this is our festive period, so and I know some of us are busy. So now let's go straight. Okay. Yes, Mustafa.
Yeah. Hi, Victor. Can you hear me?
Yeah, I can hear you clearly.
Okay. Yeah. So thanks for the session. It's my first time joining your webinar, and I must say it's been going well. So there's a statement you made. I'm trying to process it in my mind. I mean, it's not really staying. So you mentioned earlier that for management, that they prefer their current liabilities being higher than current assets because it's juxtaposed higher source of fund. I mean, more available source of funds for them, right? So I'm trying to argue that because I feel like for any business and at any point in time, there's no better way to measure a company's liquidity and efficiency management better than looking at the way they manage their current assets in comparison to their liabilities. And I would like you to probably shed more light on that aspect. Why is that like a concept for you, or is there something that you feel like I mean you're very much I don't know how best to put it, but I want to know, like, is it like a concept? Because I'm also thinking that, if we go by that, it can mean different things for different people. For the management, I don't know how they would see it that way, but for people who are just, I mean, like us, who are just like suffering through financial statements and trying to understand the numbers and scenarios and all of that, we might actually see it in a different way. Because at any point in time where current liabilities is higher than current assets, I feel like it could also mean an issue of overtrading for a company, like you also mentioned, because it means that, from the point that the company is getting its raw materials to converting it into inventory, and then at the end of the day, selling, right? It means the company is probably getting more from its supply side than it can actually sell at any time. So I would like you to probably shed more light on that. Thanks.
I love that. I love that. And I think those are things that make you a very sound financial analyst, right? Number one is understand the basic, right? And these are concepts that been coined out from different experience, right? So it's not as if it came out from a thing here. But now, to every rule, there's always an exception. And immediately you are able to think like that, whenever you put, for example, I can take a company financials and I can plug it in like this to create the shape. And I'm saying that, oh, you know what, current liability seems to be way higher. Now, as an analyst, right, based on the professional concepts, is saying don't be objective whenever you see things, right? You need to be subjective. So I take a look at it and I'll be like, okay, yeah, true, current liability seems to be higher, right? Based on our normal funding concept is saying, yes, current liability is higher than current assets. Yeah, it seems to be a good thing for the management. But what is driving this? Right? What is driving this? So if I now take their financials and I go to the current asset and I'm seeing something like deferred revenue and I'm seeing something like deferred tax, right? Which could either be under current liability or non-current liabilities. Then I need to question. And that's one of the reasons we also take a step further to make sure that we restructure the financial statement. So that when we are saying current liabilities, when we are saying non-current liabilities, we are sure that we are referring to funding. When we are saying that current liability, we are sure that we are referring to something that is clear and clear. So definitely, yes, as I said, finance is so flexible. But as I said, understand the basic concepts, then dig deep. So why is this company looking like this? What's happening? Even if current asset is way higher, it could be maybe there are too many inventories, right? Also can be industry based. There are some industries such that in December, usually have lower stock. And that's where the concept of seasonality also comes into play. And I'm preparing my financial statement at the end of the year, right? Definitely my inventory will be lower. But if I prepare that same financials for you as mid-year, then you might then tend to see higher inventory. So different things. As I said, yes, very flexible, but at times you might need to take a step further and ask for us to be sure that yes, this is this and that is that. Right? I hope I answered that question.
No, not yet. So the question actually is from the perspective of the management, right? Why should management be why should the management see it better that their current liability higher than their current assets? I mean, why should they be after that? Why should they be chasing after that based on the concept you just explained?
As I said, it's a free funding. So for example, I'm telling you are a supplier, right? I come to you and say, please give me this product and I'll pay you so number of this, right? If you've decided that, you know what, hey guy, I'm not giving you this product, that means I will need to go and get funding from somewhere. And where's the other place that I can get funding from? Is either from equity or long-term loan. If I'm getting from long-term loan, they will charge me higher interest rates on it. If I'm getting from equity, right? Equity holder might decide to request for stake in my business, which will make me lose part of my 100% control in my business, or even dividends. Dividends, which by the time I'm paying it will definitely be higher than what I would have been paying the long-term liability. Now, long-term liability also puts my business in a stress because I must make sure I'm able to meet up my interest and my principal repayment. But the fact that the guy has decided to give me, that means that guy is funding my business for that period. The staff that are supposed to be giving money, so at the end of the day, collect your own cash at the end of the day and say, okay, you know what? Hey, let me give you at the end of 30 days. It basically means I'm using the money that ought to come to me to run the business operation. So it's more like a free money that comes in. Even most companies decide to leverage on overdrafts. Why? Because you see that, okay, if I put this cash that I have, put it in one permanent investment to the end of the period, it's going to give me higher yield as compared to the interest I'm going to pay on my overdraft. So it's as good as just free cash that can be used in running the business operation for that or based on short-term basis. So as I said, yes, it's finance, right? You can disagree, you can agree. But the truth is, By the time you are faced with it, for concepts, how you've put together your analysis, is it reasonable? Can you defend it? And that's how I will end that. Right? Decide to do it how you feel, right? But the thing is, by the time you are doing it, you are presenting it, is it reasonable? And can you defend it? Finance is so flexible with that. Okay, someone want to add?
Can I add that to the explanation actually?
Okay.
So
yeah, please go.
My name is Abdulaziz actually. So based on the question, in response to the question that he was actually asking, based on the accounting concept on the financial, or call it the conceptual framework of accounting in general. So whenever we are talking about liabilities, or maybe a current liability, it's actually an obligation which is meant to be settled in the nearest future. And whenever you are settling it in that nearest future, you are settling out of your cash. So that means that there'll be a cash that is yet to leave your own purse, which is currently within your what do you call it, your finance purse currently, but you are yet to settle those obligations. So that's why Mr. Victor was regarding the current liability as something that most companies usually encourage to be higher than the current asset, in the sense that it allows for more funding, more cash, which is yet to be paid out to those who are entitled to them in the near future, based on agreements, not based on you just manipulating them, or based on trying to circumvent. It's based on agreement, as said earlier. So the receivables are what you are actually expecting from your own clients and customers. So the reason why most companies are usually expecting the current liability to be higher is just simply due to the fact that they are expecting more cash to be at their disposal in the short term, which can be used to settle the operational activities in that short term, so that in the near future, whenever they are now able, or maybe whenever they can receive the receivable from their own client, they can use it to settle the obligation. So it's just like a short-term cash that is in the disposal of the company in the short term. So there's no magic around it. It's just something based on practice, not based on maybe something of as I said earlier, yeah. As we practice, we are going to be meeting a lot of all the stuff in practice. Thank you. I hope this.
Thank you so much. I love that. I love that.
Okay. Perfect. But I want to have just a statement as well. You see, the speaker or the questionnaire or the person who has the question has been looking at, if I'm not misrepresenting his question, from the angle of an investor, not from the angle of the management. That is why when Mr. Victor is presenting or is making his presentation, saying from the perspective of the management, it is beneficial for them. But if you are to look at it from the angle of the investor, truly, it is the reverse is the case, if I'm able to make a sense with my points.
Thank you.
Actually, I think I'm not looking at it from the angle of the investors. Actually, that's why I put it in the context of management as well. So because the concept of working capital or net working capital, which we are discussing here, is that you are funding your current liabilities with your current assets. And based on what Mr. Victor has started the whole session with, he broke down the whole cycle, right? So which starts from the point where the company needs to source for the raw material, convert it into inventory, and at the end of the day, convert it into sale. So that process itself is more like a cycle, right? And at the end of the day, the receipts from the process of the sales you make, right, after the converting into sales, is what you are expected to settle your current liabilities, because the current asset is funding liabilities. So now, if you say that for management, the current liabilities has to be higher, then it means that they are owing more than they can likely collect in the future. So, and for me, I feel like it's a liquidity issue and probably inefficiency in managing the current asset. So that's my argument. So if we look at it from the management side, what it means is that the management has to, get more of supplies and then convert to inventory, and at the end of the sale. At the end of the day, you would figure that in that kind of situation, the net working capital days is going to be probably negative, because the current liability side of it is going to be higher than current assets, which means that the company is owing more than it can pay at any particular time.
Let me respond. Let me reply to your points. I'm sorry, Mr. Victor, the guest or the
Yeah,
host
yes.
of the program.
Yeah, that's why we are here. That's why we are here. At least, yeah.
Like
Okay.
what I observed or what I understood from your overall statement, you are actually correct. But that is when it boils down to you are doing a financial ratio analysis. But in the context of this webinar, it is focusing on the working capital. By you understanding what is the working capital cycle at this context and moment, but at the end of the overall of the result of this of looking into the financial ratio analysis, you can able to quantify that if at the end of the day your current liabilities is over that of your current asset, that is where it is not in a favorable condition. But in the context of working capital cycle of this financial modeling and looking into the management perspective, it is beneficial here, according to the second speaker as well, because you are expecting somewhat. Once you get your receivables, you wanted to quickly use your available fund to invest in other generated income or businesses. At the moment you get those income done or those revenue realized, you can able to use it to settle your current liabilities. If I'll be able to make sense.
Okay. Thank you for that. And I also there's a contribution in the chat box. But the truth is, yes, you're 100% correct. I won't lie to you about that. 100% correct. And I will tell you why. Our job profession as an accountant, right? And that's the way we've been taught, is to always make sure that we safeguard the interest of owners in the business. And that's why in our accounting principle, they will say that what current assets must always be greater than current liability. Or the worst, they must be equal. But you know what? In practical, in real sense, right? And I will give you a very good example. You can take your time to check, to look through it as well later. It is more like the other way around. Yes, from the old understanding how we've been taught in school is, hey, you are an accountant, you are safeguarding the interest of people that have stake in the business. So anyway, you are analyzing it, this should be it. Now, negative net working capital, the truth is good for the management. Management love it, right? But for the other side, which is where we are standing, it is not good. So based on what Kazim also said, even if raw material is obtained in credit, it doesn't imply the current liability will be greater than current assets. Both inventory level and payable will go up at almost equal proportion. Perfect. And as I say, you know what? Worst, try and maintain 1-1. So investors is saying this, management is saying this, right? Yeah, liquidity problem because you are owing and you cannot. Yes, just different story, right? And I want you to take a step further. Check different company financials, pick their balance sheet, make sure you do the restructuring so that when you are saying trade receivables, you are sure that yes, it is key trade receivables, and just try to put it together and you see different stories, right? Okay, yes. So any other contribution? I know. Okay, yes. Olatobi, let's hear from you. Olatobi.
Hello.
Okay, yes.
Hello, sir. Can you hear me?
Yeah, we can hear you.
Hello, sir. Yes, sir.
We can hear you clearly.
Yeah. I have a question to ask. My question is, this working capital that you are discussing about, we are looking at it from the manufacturing industry perspective. Okay, well, like how do we approach it when it for financial institutions like bank, insurance company, like so I know that the scenario now will be a different scenario. So how do you think we can like approach such scenario, like be about it for those in financial institutions?
So I love that, right? And as I said, it's some industry-based cycle, but net working capital, whenever we are dealing with financial institutes, we do not consider net working capital, right? Because what they do is cash itself. So most definitely they have excess cash in their shelf. So we don't consider net working capital. But when we are doing valuation of financial institution, there's nothing like net working capital there. But most time they usually have something they call capital reserved, some legal reserve they need to meet up, like things like that. Yeah. Okay, all
Thank you very
right.
much, sir.
Yeah, all right. So it's been an interesting session. We've completed our 1 hour. Do you want us to go ahead with the practical one now, or maybe we should plan another 1 hour session where we now do the practical session? Let me hear our thoughts. I was planning we could be able to do everything 1 hour, 30 minutes, but and this is festive period, so let's be considerate. Do you think we should go ahead with the practical one now, or we should just plan another webinar session where we can? Okay, so let me majority will carry the votes. Okay, all right. So thank you. So majority said we should go ahead. Okay, so we are done with the slide. So thank you all. I love our contribution. As I said, what makes you a standout professional is your ability to be able to think outside the box and to be able to question. But the truth is, you know what? Irrespective of how you want to question, you want to disagree. Always know that most of these concepts have been coined out from experience over years. All right. So it's always good understand. So I think when I was into music, they usually tell us that yes, know the rules, let it be part of you and forget it. It's funny, but that's just the truth. Okay, all right. So let's go straight to the practical aspect of it. Let me collapse this my first 3 columns. So please ask a question, ask. That's why we are here. Right. It's a knowledge sharing. So it's not, I don't usually do that kind of webinar session where participants will not be able to talk or won't be able, we just mute everyone mic. No, don't let's do that. So, and yes, when it comes to industry approach, when you are learning the concepts, the truth is, yes, different industry tends to have different, they can be diverse, right? But the truth is, manufacturing still tends to uh, be a good case for us to understand the scenario. Yes, it's easy for everyone to it's still relatable, right? Because if we go to finance now and we are discussing the terms, someone that is not in finance space, then it becomes difficult for them to even grab our case study in schools. And when in schools, they usually most times use the manufacturing because it just establishes, it gives us that basic and knowledge, right? And easy for everyone to relate. So let's say what should we call this? So networking NWC limited, right? And we want to build, so this is our networking capital. So networking capital NYC. So don't mind when I wanted to be a graphic designer before when I was in my school days. But then it's the skill was not as profitable as it is now. So most times when I'm building my models, I'm sure you always see that fuse. So let me remove my grid line. So to remove my grid line, I can just go to my view. I'll see this grid line and untick it. So let it look like a plain book, right? So I think let me freeze my panel here. So let me rename this worksheet. Let me call this input. So we're going to have input, then we have the calculation section. So let me freeze my panel here. Now we're going to have our current assets. So also know that we also shared the recording so that you can always use that to practice, right? As I said, financial modeling is practical. So let's say we have our inventories. Then we have our trade receivables. Then we also have our prepayments. I think, okay, you know what? Let's just have everything like this first. So it just for us to understand the concept. So liabilities. Then we have trade payables. So I built a model for a client not quite long. All right. And when I laid out their monthly net working capital, trust me, the net present value of the business was off, right? Was off, like negative. And the only thing I can advise them is based on this your cash cycle. You always need funding. You always need funding because you have operational expenses you need to meet on monthly basis. You need to pay suppliers ahead, this and that. So which means that you might need funding, right? And that's the whole concept of financial modeling, to aid in that decision making. Let's say, you see what your burn rate by this time, you might not be able to keep up. Unless you have a magic, you are saying on monthly basis you'll be generating this revenue, which is not realistic, right? Okay, so here let's assume we are going to have a days term. So I'll call this days term. Then I will now convert this to month terms, right? So as I said, please always remember, finance is flexible. It's flexible, and that's why if you are really into finance, we say that this one will develop his own concepts, this other guy will come and counter it. This one will say this, will say, oh, these are the disadvantages, these are the disadvantages. Someone will introduce his own. So that's more like it, right? Finance is flexible, adjustable to risk. Okay, so let's say our inventory days. Now, this part is very important because I can tell you that a business owner lost an investor because of this. Yes, because when you meet real investors that really know about financial statement interpretation, you see all those figures you've cooked, they will help you interpret it clearly. Now, let's assume from that our case that we've been using, our inventory days there. Okay, let's just say this inventory take 20 days. Let's say 15 days for them to get it out. Let's add a unit here. So this, let's try to. So structuring is very, very good when you are building your model. Don't just build it and it's looking somehow. So units, this is this. So let's also say our address receivables. Let's say it will take us 20. Please, these are fictitious data. 20 days, right? Then for our prepayment, because we know that you need to prepare some expenses ahead. Let's just say most time it's 30 minutes. For example, you pay your rent. Okay, is short-term borrowing not included in net working capital computation? No, I mean, that's a very good question. I think I mentioned that. No. So any line item, remember, net working capital is how we've managed our cash. So anything related to cash, we remove it. For example, in current assets, your cash and cash equivalent, you remove it. Your restricted cash, you exclude it. Your marketable securities, you exclude it. In current liabilities, things that are interest bearing, so which means the source of cash that has flowing into the business, you remove it, right? And short-term borrowings, our overdraft, you remove that. Some call it revolver, right? Okay. Then now on our trade payables, and let's revisit this. Let's revisit our guy here. That was scenario one. Let's revisit this. So we are saying inventory days 20 days, receivable days 30 days, and our payable will be what? Will be these days, right? Okay, so sorry a little bit. Let me switch my screen. So please, a minute. Okay. Okay, a minute, please. All right. Okay, so now here we have inventory days of 15 days, trade receivables 20 days, and prepayment 30 days. Right? Basically means that our trade payables, if we are saying we are following the first basic concept, where we are paying our suppliers at the end, right? That means our payable days cannot be lesser than our inventory days plus our receivable days. Right? If you are picking the first scenario, what we are saying is that our inventory days plus our receivable days, right, should either be equal to our payable days or higher than our payable days. So that is, let's assume I'm saying, hey, my payable days will be 30 days. Right? What I'm saying is, if I add up my inventory days plus my receivable days, that's 35 days. That means I'm saying this business will need funding to pay these suppliers in 30 days. The next question is, where will this business get this cash? Have I made provision for that in my model? Or if I'm saying, oh, we pay trade payables in 20 days, that means the next question is, where will I get this fund? Right? So most modelers usually make this mistake. So if I'm saying my trade payables, I will be paying them lesser days as compared to my inventory plus my receivable days. It means I'm saying this fund will be coming from somewhere. And have I captured that in my model? So for this our own, this is 35 days, right? So maybe let's say it's 5 days. Let's add additional 5 days. So let's make this 40. Let's keep it simple. Accrued and other payables, let's also take that maybe 30 days, right? Or maybe 25 days. I think salaries and all those things are more of 25 days in nature. I have this. This is what days term. So I usually leave this as an input. Now, because I want to build a monthly model, and I'm assuming I will be preparing my reports at the end of the month. Now, because of the flow of different transaction cycle, this inventory 15 days can even start on the 25th. It can start on the 15th. It can start on the 1st. It can start on the 38th day. Right? So which means if it's starting on the 15 or it's starting on the 25, that means it will definitely flow into the next period cash impact. And that's why what I do is I usually convert this into a month term. So I need my, let's say I need my days in a year. So our financial modeling concept is saying, do not add code in any formula. Always make sure you create it as inputs and link your formula to it. So month in a year. So this will be days, right? And this will be month. So when you are building your model, always make sure you follow the best practice. Be a professional. So days in a year, let's assume that's 365, right? Months in a year, that's 12 months in a year. So I now need to convert this into what? Into a month state. As I said, based on that concept of because different transaction flow. Some might be the beginning, some might be at the middle, some might even be at the end, right? So what I usually do is I will divide this my days term. I will divide it by number of days in a year, right? So I always make sure when I'm putting my formula, it's very, I structure it very well. Then I divide this by what? I divide it by the month in a year. It's going to give me something like 0.00 something. And what will I do next? I will now round it up. I will round it up to the closest, okay, so put another bracket. So I will round it up to closest 0 so that it gives me 1 month. So let me remove this decimal, it's too long. So basically, I'm saying this inventory will take a month. So which means from processing and getting it ready should take a month. My receivables, if I copy the same formula down, okay, so let me lock our 365 days and also log the 12 months. If I copy it down, trade receivables 20 days. So which means if we have a sales in this month, that means we are making provision and we are saying that, hey, we might not be able to collect our cash in that current month. We collect it in the next, we impact the next cash, which means that's when we'll be able to get that cash. Right? Because we said this, we have multiple transactions. Some might occur at the beginning, occur at the end. Right? As I said, it's very, very flexible. Very, very flexible. If you feel, oh no, you know what, based on our home business, this is how we operate. Fine. But because of different transactions that occur, we might need to consider that we call it more like a mid-period adjustment. Right? Okay. So prepayment, I will also copy that down and take a look at the flexibility that we have in this. Okay, please a minute. Let me reshare my screen. Okay, all right. Okay. So which is, so I can even format this so that it's appear in month. I'm sure we know how to do that formatting thing. So month. So that it looks something like this. So which means if we decide that, hey, you know what, our receivables, any clients we sell to, maybe we give them like 30, let's say we give them 40 days. So by the time I put 40 days here, basically what I'm saying is this should be more like 2 months. So let me put 40. Okay. So let me look at our formula. It's supposed to give us something around. I've done a mistake. So that's one thing I want us to understand, right? Mistake is normal thing, right? And the way this Excel is just garbage in and garbage out, right? So which means if you've done your calculation wrongly, you will get wrong answer. But what you can always use to check is know what your output is supposed to be. So if I put a formula and I'm looking at the output, right, and say, yeah, no, this is not giving me what I want. So immediately I type 40 here. Normally this is supposed to change to 2 months because this is now greater than 30, right? And that's why, because of what I've done mistake in my formula. So let me compute that. So equal to, so I'm saying my inventory days divided by my 365 days, which I'm going to keep constant, right? Let me do that. Let me zoom down a little bit so that I can see everything else. Okay, yes. So equal to, let me put it in brackets. My inventory days divided by my 365 days, right? So instead of dividing, I'm supposed to multiply it. So basically what I'm saying is these days in a month, right? This represents almost 0.0041. It's compared to a whole total days, right? So the days in the period. Then I now multiply that by 12. Keep it constant. So instead, we're dividing it. So now I can now round it up. So the that's 0. Then I have this. So this one that is 40, you see definitely it will now show that it will be in the next 2 months. So if I put it as 30, it still recognizes it as 1 month. Once it's above 30, it recognizes it as 2 months, right? What if it's 60 days? They recognize that as, so 61 days. So you recognize that as 30 days. Right. Okay. So let me change back. I think we have 20 days here before. Okay, yes, good. So I can copy the formula, paste it here. Right. So we have it in our monthly terms, and we also have it in our what? In our monthly, so in our days and also in our monthly terms, because our model will definitely be a monthly net working capital. Now, we also now need to factor in what we call seasonality. We need to factor in what we call seasonality. And how, so you can use different approach. As I said, this thing is flexible. But what I want you to know that, see, there is a way you can make it operational that will mirror the reality of how your business operates. Right? Typically, what we all know, most people know that is just receivable divided by days in a period multiplied by 365 and they move on. No. Can make it operational. Now, you understand the basic concept and you can always modify it to fit what you want. So here, I'm going to create more like a yearly month in a year. So January up to, let me just drag down, up to December. Right? So January to December, then let me bring all my line item. Let me bring it here. So this will definitely be in percent. This will be in percent. Then I need to get something. So more like I need, this is January. January is 1, right? February is 2, March is 3. So more like the month value. But I don't want to add code it, right? Because when you are building your model, you also need to incorporate flexibility into it. So because if your own is not starting in, because if you build a model and you said it to a client and they say, oh, you know what, we're not starting our operation in January, we'll start in March, and they change it, then the whole model scatter. So what I usually do is I use a formula called month, right? Select this January that I've typed here, I think, and 1. So that will give me the respective month dates. So 1 to up to 12. So you can see that. So instead of typing 1, 2, 3, so I just automate it. So maybe we are starting in March and I put it as March. You see that it just automatically change the month value. Okay. Then let's assume this is our inventory. So let me shorten this. This will be our receivables. Okay, receivables. This will be our receivables. This will be our prepayment. And this will be our trade payable. We can have our accrual. Right now, what are we trying to do, right? What do we want to achieve? So we want to build in a seasonality. As I said, there are some business such that because of the flow, their business operations, there are some times where they have more inventory in their store, right? There are some period where they have less inventory. There's some period where they know that, for example, for manufacturing, usually do that close to the end of the year. You know what they will do? They will make sure they get all the stock they have. They can even sell it at discounts. They will make sure they take it out of their shelf, give it to the distributor. They tell them, you know what? Yes, owe us the next year. We don't mind, because what, they can recognize the revenue based on our accounting concept, right? They can recognize the revenue. So which means if you check their balance sheet as at that December, you see that they will have higher receivables. And whereas what they've done is to just what, in order for them to meet their budget, they've pushed all their inventory out and to their distributor, right? So what we just want to do is to be able to now use this. Let me put this in. I don't mind me. I just like making my work look neat like this. So we are now going to create something. I'll put this in percent. So we just to create that flow. So here by default, I'm saying, so let me put everything as 100%. And what I'm saying is, I'm saying in January, any outstanding receivables that we need, right, to come in that month, we are going to get 100% of it. Right? There are some where we're saying, oh, maybe in January, because of the nature of festive period, maybe we might be getting maybe 80%. So you can it's just about you being able to think through it. And is it reasonable? Am I mirroring reality? Right? So it's like that maybe in January they will have lesser receivables, people will be owing them a lot. February maybe the same thing, right? And I'm saying maybe in June, May, at least We make sure we send our marketers to make sure they collect everything. Maybe I'm saying here we might even be able to get 120%. So just you building that flexibility and look at the flow and how it will affect the business operation. If you look at your statement of cash flow and see that in this particular month, right, maybe the business has to meet up a specific financial obligation, and see that, hey, I'm at a negative cash stand here. What can I do? Oh, I've even sold to my customers, and if I manage to collect this cash from this person, it will be able to meet up this liability, and I won't maintain a negative cash. Then they start pursuing that client. So, as I said, it's all about reality, which must be modeled, right? And I feel we as modeler, we also need to start doing more to also help, especially most of these startup. For a typical corporate organization, they understand these concepts. That's why they've been able to survive over the years, right, without struggling. Okay, so let me put everything back to 100 so we can always change it and see the flexibility. Now, there are some cases where you also need to make provision for irrecoverable debt. And we can, should we cover that in this session, or we make it maybe some other session? At least don't let's go too deep here, right? Because even in financial industry that gives loan, they also, this more like how they tends to make provision. Okay, you know what? If you have these people that have given loan, maybe we should so expected credit losses. Yeah, I think that's what they call it in the finance space. So right, so things like that. So I have a receivable here, maybe I should just write off 10% of it. So you create that table, you also make provision for that, but we are not going into that today. Let's keep it simple. So now, let me bring in my inventories. Let me bring everything. Let me bring it down here. So what I need now is remember my model will definitely go like this. So let me say this is month 1, this plus this period plus 1. So let's assume our model will be for 5 years. So which means I need 60 months here. 60 months. So 60 months, we have 60 months here. So let me readjust my panel. Let me freeze it from here. Let me adjust my freeze panel. So this is our monthly period, right? And here I can close my Excel. I can close my Excel worksheet from here. So I just click on this header, the column header, Control Shift, right arrow. So which means I highlight to the end of my Excel. Then right click and I'll click on hide. So I said we share the recording with us. So yeah, I know I can be fast at times. So which means from here now, we can see the end of our Excel. So we don't need to be, just put the formula in first month and drag it for the period. So maybe I should rename this so that we know this is month. Okay. All right, so month 1, yes, good. So what I want to do is I need to bring this guy, right? So that whenever it is month 1, so okay, we need to do another thing, right? So the other thing we need to do is we want to be able to recognize that, yes, everything here. So what I'm going to do is, now I won't share the Excel. No, I won't share the Excel. I will only share the recording. So I need 1, 2 here. I will share the video so that you can do it on your own. Yes. Right. So 1 to 12. Then other years, I will just reference it so that I have the same thing. Yeah, I will share the. I don't usually like sharing the file. Yes, I want you to also sit down and do it yourself. It's easy to see someone doing it and think, yeah, you understand it, but sit down, take your time and do it. Okay, right. So what I've done is I've created. So this is month 1 to 12, right? Represents 1 to 12. So month 13, that means another year is starting, right? So 1, then another 1 to 12, right? Then month 25, another 1 month is starting. So that's more like this, the seasonality. So here I'm going to use my index formula. So in case you don't know index and match formula, this is a most known function for you as a financial modeler. Yes, very, very powerful. So index is asking for the array, which means what I want back as my output, right? Then comma, then I'm going to match. I'm going to match my month here. That's 1 to 12 that I've created. I can keep the row constant, comma. I want to match it to this guy here. So I'm going to also keep that constant 1 0. So as I said, yeah, I'm going to share this so it can be funny at times, but this is just what we are going to have. So for you to see the flexibility. So January. So let's assume our January we are saying 50%. So you can see January here, 50%. If you come to another January here, right, you can see another 50%. You go to another year where one is starting, which represents January. Another one is also there. So I can copy this formula. Let me copy it down. So I like working smart. And that's one thing about financial modeling. So you can copy this other one, right? So as you are doing it, always test to be sure it's working. Yeah. It's not complex, don't worry. I know it might look complex. So this one, I'll just move this to the prepayment. Move this to the trade payables. Then I'll move this to our accruals. So I don't know. Some people used to say there's basic financial model. I don't think there's anything like basic financial model. Financial model is great. It's great. Let's put it that way. Some say beginner, some will say advanced. I don't know. Okay, all right. So now that we have this, so I'll call this our seasonality split. So seasonality split. So you can, as I said, you can be creative, you can be dynamic. If you feel, I would love to approach it like this, good. You can do that. You might need to include this. You are free to do that. But the whole thing is understand that yes, there's a way this can be done. This can be done. Okay, so this is the seasonality. So what I'm going to do is now let me extract financial. Let's call this financial statement extract. So I'll just create like some fictitious assumptions. So let me call this revenue. Then USD. Let's put it in million. Let's put it in million, right? I just want to get fictitious assumptions, please. So equal to, I put random. So for us to get a random value in Excel, so rand between, let me use my rand between, it's 100 million to 500 million. So I even love this. So that's give us something like it's not as if it's a continuous growing value, right? Because the truth is, there's really no business that operates on a constant increasing growth rate, right? So I can now copy it and paste it as value. So sorry, your own value might be different from my own by the time you use your own formula. I just want us to have that zigzag. So if I put it in a map, if I put it in a graph, let me see how that looks like. Okay, good. In fact, perfect. And the truth is, if you take a look at most companies' monthly financials, you can hardly see just a straight growth. So January growth, yeah, you can have exception, but I think this is more like the real kind of thing that you see. So I think I love this. So you see up, down, up, down, up, down. So I love that. Good. Then what will be, I think we're going to need our cost of sales, right? So let me see, cost of sales. So please, in case you have any question, you can always ask. So I said you can always ask questions. So let me just say this, multiply by maybe, let's say 45%, right? 45%. Also copy that and paste it as value. So it's not a formula. Then we can have our operating expenses. So maybe I should say equal to this. Maybe I say 55% of our revenue. can have it. So just to get those fictitious assumptions like that. So let's take a look at our total cost. So for our total cost, that will be equal to our cost of sales plus our operating cost. Yep. I think it's almost equal to our revenue. No, that's too much. It's the same thing. Total cost equal to our revenue. So let me reduce. Let me see what I can reduce. Okay. Mustafa, okay. Want to say something? Okay.
I was
Yeah.
wondering where you put 75% of the operating expenses. That would have been too high.
I think
Yeah, maybe
that's
just
true.
make it like 10% of the revenue or 20%.
Let's say 25%. Yeah, 25% should fall. Okay. I think yeah. So this fair enough. So remember, you just fictitious assumption. By the time you are building your own model, I'm quite sure you'd have calculated your revenue, calculated your cost of sales, and your operating cost. So this one is just summation of these two guys. Okay. Sorry, Excel is hanging. Right. Wait. I did not save the documents we've been working on since. Interesting. That's not. Jeez. This thing can happen to anyone. Wow. Guys, see what we have here.
But I thought it brought out the save panel not quite long.
I forgot to save it. So this is a very good experience, right? I've worked on one project like that, spent almost how many hours, and I forgot to save it, and everything just went off.
You can click on that.
You can recover it.
Click on that.
This is the only last recovery. You can see that there's no even version history.
Wow.
And I would have saved it on my drive.
Very serious.
Oh boy.
Okay, you know what?
This life scenario.
Exactly. As I said, it has happened to me before. Not only me. One of my parts, that day that it happened, I just had to close my laptop and I went to sleep.
Unfortunately, you can't go to sleep here.
Yeah, don't worry. I'll quickly.
Thank you very much. Well done.
Man. But that's a
Try
good
to remember
life
to save now.
So I said my company, our number one rule is immediately you open the file, save it straight to your OneDrive. Save it straight to your OneDrive. So let me do that. So don't let me miss this out again. Sorry guys, it's a good experience. So let me just save it straight on my OneDrive. Man, being a financial modeler it's not easy. I won't lie to you. But trust me, it's worth it. You're out kick. You're out kick. So let me quickly redo that. So I need 60 months. So sorry guys. This is what we call breaking transmission. I need 60 while you're not counting for me. So you can also use your series fill for this. So let me close this. Sorry guys, so let me quickly redo it. Don't worry, I'm very fast. I'm doing this on my own. I can decide I'll just close the laptop. Because this can be funny at times. So index this, then I'm matching that, matching it with this guy. Make that match. Sorry, guys. It's one of the experience. Imagine your boss is requesting for a model and you've been working on it, you forgot to save it. And you need to present it to the board only for the Excel to just close. Then what will you do in that moment? The seasonality. Right, so financial statements, extraction. So also as a financial modeler, please always remember, typing should be more like a basic thing for you. It should be the last thing that will even waste your time. Yes, please. Because you're also writing the financial modeling exam, where you have four hours to deal with a case study. I'm quite sure you don't want to waste time on just typing. Okay, so cost of sales. So equal to our cost of sales multiplied by our sale, that should be 45%. Then operating expenses multiplied by Z25%. Then our total cost of sales plus our operating costs. Okay. All right. So back to where we back to where we started from. Okay. All right. So now we have our financial extracts, and let's get started. So I will do like one or two for us, and I think that should also guide us in how we deal with others. So let's create our inventory schedule. Now, please note that where you have access to information and you can model out the inventory very well, please do. But where you really don't have access to that kind of information, you can just apply this approach and move on. Right? So here, I'm going to say our beginning balance. Then we are adding our, let's call it costs. So cost, we're adding our cost of sales recognized. Right? Then we are going to reduce our inventory sold. So we could either use inventory. So I think most time I use inventories, or just say cost of sales recognized. So either of the two. I said if you have access to the information, you can go as granular as you want to. But most time going to granular can set you up. So always remember that. So keeping it simple, make it basic. So beginning balance will be the closing balance for previous period. Right? So our ending balance will be beginning balance plus inventory recognized minus the what? Minus the inventory sold. So let me put this. Let me format this. So let me format this so that our normal is, I want that 0 to show us dash. Okay, good. There's some few formatting. Okay. So our inventory, our cost of sales recognized, I'll just bring that here. Right. So if you have this inventory, maybe you have information to the total stock purchase and all those things. Yes, you can also make use of this, right? Your stock purchase, the value, and everything like that. So inventory sold. Now, this is where we now need to make use of our offset. So my inventory days, I'll just link it to this inventory month terms that we've created here, right? And I'm going to use my offset function equal to offset. So offset is what we usually use. So what I'm basically saying is this 162 here now, right? The stock and the inventory, let's assume we are getting everything came in this month, right? And we're saying, hey, before we get it out, before we do the processing, to take 15 days. So we are saying, hey, you know what, that 15 days could be beginning, could be middle, could even be the end. So you know what, let's just consider it as the next 1 month for us to recognize that, to get it out of our shelf, right? So equal to offset this guy. For my row, I do not need anything. For my column, so for my column, then I need my column, that the column, let's see. So we do not need anything for the rows. Then for the column, so in case you don't know much about offsets, we might want to check that. So that will be minus our what? Minus the inventory days. Close the bracket and press enter. So which means in this first period, nothing will come in here. So in fact, at times, you know what? Okay. So let me put this in negative. Then I can sum everything up together like this. Yeah. So you can either use either of the approach. So which means by the time I get to month 2, so basically I'm saying this inventory that we recognize in year 1, this is when it will get out of the stock, considering, because we've considered that we might have multiple transactions, some might come at the beginning, some at the end. So it's better for us to just recognize this. So which means for us to buy this, right? If you are saying we are not getting this on credit, that means the business needs to be able to pay that, which will also reflect in our payable. So both of them must connect. They must speak to each other. So let me copy this to the right. So you can see that at every period, what you have in the previous month, we then go out. What you have in the previous month, we go out in the next month. So you can be flexible with that. Then let's bring in our seasonality. So inventory, seasonality. So this is percent which we've created. So I can just link that to the one for inventory, represent. So we are saying, yes, we are recognizing everything. So I multiply that by the percent so that we are recognizing everything at this period. So maybe there's where you have a scenario, maybe at the start, might not be able to even get everything out, maybe 50%, 50% the following period, maybe 80%, then here I'm saying 120. So if you look at the flow, you just see that, you see, you have higher value here, higher value, then the next month reduce. So you can have that kind of zigzag. You just making that provision for what? Seasonality. And you can also add cases here where you make provision for, you just maybe be provision for losses in good and just something, just making that provision, right? But we won't go to that part today. Then for our receivables, okay, don't mind my spelling, ski. So receivables schedule. All right, so here we're going to have our beginning balance, right? We had the revenue recognized. Okay, yeah, someone has a question. Yeah, please. Revenue recognized.
Okay, thanks, Victor. Can
Yeah.
I go ahead?
Yeah, please go ahead.
Yeah, I was going to ask that the seasonality of the thing. If you have access to historical information, how can you use that to extrapolate what the seasonality should be? That's number one. Number two, I see you assuming no provision for, say, inventory loss or something due to maybe expiration or any other thing. Yeah, right. So, you know, in reality, there will always be that. I
There
want
will
to
always be
suggest
that,
that,
yes.
yeah, or if you don't mind, you just, since you'll be sharing this, you could just create that line and assume 0 based on this. Thanks.
Okay. All right. Thank you for that. So yes, for company that has historical, yes, we can take a look at the historical trend, as I said, because you can calculate it backward, for you to say what's our inventory days, right? Because always remember, balance sheet is always at a particular period, right? So which means if I'm saying December 31st, that means because you know it's accumulating, so and it's always at a particular point in time, right? So even if someone has been owing you since 2 years ago, it will still reflect as at today in the balance sheet because it's at the end of that period as at that particular day. So yes, you can use that as well. So for the provision, I said because of our timing, I was hoping we just use 2 hours. I think we use more than 2 hours, though we are almost done. Yes, you can create that provision. Okay, so maybe I can share this, then I can add that provision for where you can make provision for inventory losses. In fact, the same receivables, irrecoverable receivables, and trade payables, you can even have discounts. So you can, as I said, you can be flexible and be creative with that and include it. Okay, so maybe I should just include this. So maybe provision. So so maybe you less. Are you lessing or are you adding? I will leave that to you. So provision for losses, right? And I will leave that to you. So then let me update our formula so that they include that as well. So you can also do the same thing for our receivables. So let me put this back to 100. Just use that as an example so that you can see the flexibility. Right, so for the receivables, we have a beginning balance, closing balance for previous period. Then our ending balance will be beginning balance plus revenue recognized minus revenue collected for that period. Let's just sum it up so that I can put what we are deducting in negative. Okay, so revenue recognized. So for example, if for a company that has historical, definitely you have something at the beginning balance. For example, let's say this company has, take a look at their balance sheet, you see that they have something around 500, right? So which means it will automatically flow into this. And what that will do is it will also help to keep your monthly schedule balance in line with the historical trend. Yeah, because that's one of the problems and almost corporate modeler usually have, right? Yeah, because this company has historical. You look at the last balance sheet, it was almost 5 billion. Then your own working capital based on your own model is saying something million, right? So using this approach, we also have to take care of that. Okay. So revenue recognized, let's link that to our revenue here. The revenue collected, let me bring in this our month term, enter. Then I can use offset. I like work smart, so I can even copy this guy, paste it here. So the formula. So when you write your formula, always think about you reusing the formula. Right. So for my seasonality, I'll just copy this guy. So I don't need to change the name. So I don't need to be redoing the format. Receivables, seasonality. Then I can link that to its own as well. Here. Then it flows like this. So okay, so let me bring this to this guy. You can see our receivables, copy our revenue across. So it also flow like that, right? So this is where you know that, hey, I might need to collect my money as soon as possible. So also you can have, I think you can have also make provision. So provision for irrecoverable or something like that. Right, there's some they call it amortized and all those story. I'll leave that to you. As I said, once you understand the basic, you can be creative and create your own. Right. So I like keeping to time. We are 2 hours on the dot. So this note, I think we might need to call it let's call it a session. right? So maybe in subsequent session, I'm also bringing some experts in the feed to also tell us more about inventory, how they tend to manage it in their company, right? People that have experience in modeling, all right? If you're also here too and you'd like us to set up a session where you can also share your knowledge, but please, I will need you to make it practical. I don't like those kind of webinar where all I need to do is just be seeing slides, right? Put something in Excel for me, make it practical so that when I'm building my model, I can always apply it and know that, oh yes, this is the way you've done it. All right. So I thank you everyone. And as I said, I will leave you to do the rest. We've done inventories, we've done receivables. You can just go ahead and complete this on your own. In case you have anyone that we also like to share their knowledge with us, please reach out to me so that we can set up another session. But I feel that might be next year, right, for us to continue. But this is more like how you approach a monthly networking capital. Trust me, I'm not sure. I don't know of any courses you want to go and take online that will teach you this. Yes, in case you've done any course, right, and they've been able to capture this, please let me know. I would love to check the course out again. But I'm sure I've done so many courses, and building a monthly networking capital is always issue. Yeah. So, all right. So thank you, everyone. Thank you for taking your time. This is a festive period, and this is your own investment. Trust me. And for you to be here, your data, right, your time, and everything. So thank you so much. Thank you. Yeah. So the recording, I'm going to share that with everyone. Yes, the same email that was shared with everyone, I will share this with every one of us. So thank you for your presence in the session, and please make sure you enjoy the rest of the day, enjoy your festive period. So in case you have any addition, any comments before we close the session, I will just leave that. But officially, I like keeping to time. Yes, we started 11 on the dot, so I make sure we stop 1 on the dot, right? So thank you, everyone. And please, I will just stay back maybe 2 or 3 minutes. If you have any contributions, something you want to tell us, or maybe you even like to share your knowledge with us, we can make plans for another session, which will be next year. And I'm sure everyone will be glad to also to have you in our session, right? So please remember, knowledge sharing is very important. When you teach, you know better, right? Our new generation are coming up, and we don't need to throw them into deep sea. They need to know it's right, right? And that's one of that's how you can give back to the community, right? So some of us were so lucky to have learned this concept from the fathers in the industry. So it's now also our own responsibility to make sure that we treat them in the right way so that we can keep a well knowledgeable profession across. All right. Okay. So thank you everyone. As I said, if you'd like to speak in our next session, just let me, you can reach out to me, email. We set up a webinar like this, and we can even form a community from this. Okay. All right. Yes, please go ahead.
Yeah. Morning. Thanks very much for the course. Really appreciate it. And I will be looking forward to the videos. I would like to have a one-to-one talk with you. I don't know how possible is that.
Okay, I think the email I sent to you, there's my number and email, so you can also check me out on LinkedIn, so we can also discuss for that.
Okay, I've seen your number. Okay, thank you. Yeah. Thank you.
All right, thanks. Okay, yes. So yeah, please.
Hello.
Diamaka, yes, please. How you doing?
Thank you very much. Can you hear me?
Yeah, I can hear you clearly.
All right, thank you so much. Mr. Victor, I really appreciate today's webinar. It was very nice, but I don't think I'm part of your group. I didn't get the email. A friend of mine just sent me the link and was like, if you're interested, you could join. So I don't know if there's any way I could like get access in case of further webinars. I don't know.
Okay, so you can just any session I want to have, I usually post that on my LinkedIn. Right. So and this session will also be uploaded on my YouTube channel so that you can just catch up from there. So just go to YouTube, so just type my name on YouTube